Just 2 years ago, Cape Coral was the poster child of Florida's housing boom. Prices soared 75%, remote workers and retirees flooded in, and open houses drew lines around the block. Now, as home values crash, Florida's governor scrambles to contain the fallout, with inventory exploding by over 225% and nearly 1 in 12 homeowners underwater on their mortgages. Banks are tightening, foreclosure warnings rise, and the governor's much-touted rebate is dismissed as too little, too late. So how did America's hottest market become its most desperate, almost overnight? The unraveling of Cape Coral's dream is more dramatic and more urgent than anyone expected. By the spring of 2021, Cape Coral was a magnet for anyone chasing Florida's promise of sun, space, and a quick profit. Mortgage rates hovered below 3%, fueling a buying spree that cut across retirees, remote workers, and families priced out of other markets. Lenders wrote loans at a pace not seen since the last boom, and cash offers arrived from out-of-state buyers eager to escape high taxes and colder climates. U-Haul shortages and jammed highways became routine as nearly 314,000 people relocated to Florida that year, with Cape Coral among the fastest-growing destinations. For many, the decision was simple arithmetic. A couple from New Jersey could sell a modest home for $600,000, then buy twice the space in Cape Coral with money to spare. Young families, squeezed out of northern suburbs, found listings at a fraction of what they'd pay back home. Remote workers, no longer tethered to city offices, saw palm trees and canals as the new backdrop for Zoom calls. Word spread quickly. Cape Coral wasn't just affordable, it was accessible. The math got even better for first-time buyers. With mortgage rates dipping under 3%, monthly payments on a $350,000 home rivaled what many paid in rent. Lenders, flush with applications, locked in loans for half the city at historically low rates. Agents described bidding wars that started before the first open house, with buyers waiving inspections and contingencies to get a foothold in the market. Retirees joined the rush, trading snow shovels for sunshine and fixed pensions for fixed-rate loans. For every family unloading a moving van in a new development, another investor closed on a pre-construction contract, betting that values would keep rising. Scarcity and urgency fed on each other, driving prices higher and buyers to the edge. Cape Coral's population swelled, its streets filled with newcomers chasing the same dream. The city's identity shifted almost overnight, from a sleepy Gulf Coast haven to a national symbol of the pandemic migration wave. Demand outstripped supply, and the stage was set for a builder frenzy that would redefine the landscape. Builders in Cape Coral faced a race against the clock. By mid-2021, county officials issued over 8,000 single-family home permits, nearly double the pre-pandemic pace, with Cape Coral accounting for almost half. Construction crews worked dawn to dusk, pouring foundations in new subdivisions that seemed to spring up overnight. The skyline bristled with cranes, and freshly paved streets wound through what had been open fields just months before. Every week brought more for sale signs. Investors snapped up pre-construction contracts, sometimes sight unseen, hoping to flip for a quick gain. Bidding wars became routine. Homes under $400,000 rarely lasted a day on the market. Some buyers, desperate to secure a deal, waived inspections and dropped every contingency. Agents described offers coming in before listings even went live, with cash buyers pushing prices tens of thousands above asking. By April 2022, the median sale price in Cape Coral soared to $441,000, up nearly 75% from 2 years earlier. Lenders locked in ultra-low rates for half the city, cementing the sense that this boom was different. The mood was electric, even reckless. For every moving van unloading furniture, another builder rushed to break ground on the next lot. Permit offices struggled to keep up with the avalanche of applications, and local planners warned that supply was outpacing even the most optimistic forecasts. Appraisers, meanwhile, struggled to keep up with the surge. Reports of homes selling far above appraised value became common, and some deals fell apart when financing couldn't bridge the gap. Still, the appetite for new homes seemed insatiable. National analysts began to flag Cape Coral as one of the most overvalued markets in the country, but on the ground few were listening. The city's housing market had reached its high watermark, prices at record highs, construction at a fever pitch, and optimism crowding out caution. Warnings began to ripple through Cape Coral's real estate community long before the headlines caught up. By late 2022, deal sheets at closing tables started to unravel, not because buyers lost interest, but because appraisals simply couldn't keep up. Contracts written tens of thousands above asking price ran headlong into appraiser reports that pegged values far lower. In some cases, the gap stretched $15,000, $30,000, even $40,000 below the agreed sale price. Lenders balked, and an estimated 13% to 18% of pending contracts in Lee County failed to close in the second and third quarters of 2022, with Cape Coral leading the fallout. Professional investors took notice. Hedge funds and iBuyers, once eager to snap up new listings by the dozen, began circulating internal memos warning of concentration risk and unsustainable price velocity. By July, Opendoor halted new purchase offers in all Cape Coral zip codes, citing rapid softening and appraisal volatility. Invitation Homes and Progress Residential, two of the largest single-family rental platforms, shifted from buying to selling. Public filings showed their Cape Coral acquisitions dropped to less than a fifth of 2021 levels. By early 2023, for these firms, the calculus was simple. As soon as appraisals lagged and contract failures mounted, the risk of holding inventory outweighed any potential upside. Local agents reported a new kind of tension behind the scenes. Deals that would have sailed through months earlier now bogged down in renegotiations or collapsed entirely. Appraiser guilds and brokers described a summer where nearly every contract above $350,000 required a second look after a low appraisal. Buyers, especially those relying on financing, found themselves squeezed between sellers unwilling to budge and lenders unwilling to stretch. The result was a visible uptick in failed escrows, particularly on investor flips and pre-construction assignments. Analysts like Jason Luris of Parcel Labs put it bluntly, with so much supply, very little demand, and over 50% of sellers cutting prices, I expect this downward trend to continue. His assessment echoed through industry webinars and risk committee meetings. As institutional buyers paused, the market's support beams started to crack. The professional withdrawal didn't make headlines at first, but it set the stage for the external shocks that would soon hit Cape Coral's fragile housing boom. Hurricane Ian's landfall in late 2022 sent shockwaves through Cape Coral's insurance market. Within months, homeowners opened renewal notices to find premiums had doubled, or worse. For a typical house in central Cape Coral, the average annual premium jumped from under $3,000 to nearly $6,000. On older pre-2002 homes, some renewal quotes reached $7,000 or more, with hurricane deductibles climbing from 2 to 5% of dwelling value. Insurance carriers, battered by record claims and soaring reinsurance costs, began to withdraw from the region. People's Trust and United Property and Casualty either tripled their rates or exited entirely, leaving thousands scrambling for coverage. Citizens Property Insurance, the state's last resort insurer, saw its enrollment in Lee County swell from 8% of policies before the storm to over 30% by 2024. Agents described multi-week quoting delays, with many private companies declining to write new business at any price. Some homeowners received abrupt cancellation letters. Others were offered stripped-down policies that excluded wind or capped roof coverage. For families with mortgages, these changes weren't optional. Lenders required proof of full coverage, forcing many to accept whatever terms were available, no matter the cost. The financial strain was immediate. Monthly escrow payments spiked, pushing some buyers' debt-to-income ratios beyond lender limits. Deals in progress fell apart as insurance quotes shattered budgets. For existing owners, the math no longer worked. Retirees on fixed incomes watched their housing expenses balloon. Young families who bought at the peak now faced insurance bills rivaling their mortgage payments. In neighborhoods hit hardest by premium hikes, listings multiplied as owners tried to escape the squeeze. Regulators in Tallahassee fielded a flood of rate filings, with dozens of insurers requesting double-digit increases. Public hearings grew heated as residents demanded relief, but state officials warned that denying hikes could trigger more carrier insolvencies. By early 2023, the insurance shock had turned Cape Coral's affordability crisis into a full-blown exodus. The promise of Florida sunshine had collided with the hard reality of climate risk and an insurance system buckling under pressure. For many, the only option left was to sell, if they could find a buyer. By early 2023, Cape Coral's housing inventory started to balloon at a pace few could have predicted. Listings in Lee County leapt from 3,500 in the first quarter of 2022 to over 12,000 by the spring of 2025, a 225% surge. Entire streets that once hosted bidding wars now lined up with for sale signs, each one competing for a shrinking pool of buyers. The days on market, a figure that had hovered in the single digits during the boom, stretched past 3 months for many properties. Idle construction sites became a common sight. Builders who had raced to pour foundations in 2021 and 2022 found themselves with half-finished subdivisions and no buyers to fill them. Some slashed prices to move inventory, while others paused projects entirely, leaving rows of vacant lots and half-built homes. Permits that had been pulled at record rates, over 8,600 in Lee County in 2022 alone, now represented a backlog, not a pipeline to profit. The supply glut was not limited to new builds. Homeowners facing ballooning insurance premiums and rising property taxes listed their properties in growing numbers. Many hoped to cash out before prices fell further, but the sheer volume of homes for sale overwhelmed demand. The market, once defined by its scarcity, now struggled under the weight of excess. For every seller, the odds of a quick sale faded as competition intensified and buyers grew more selective. Builders retreated, and the city's landscape shifted once again, from boomtown to a market saturated beyond recognition. By May 2025, Cape Coral's housing market stands in stark contrast to its pandemic peak. The median sale price has tumbled to $361,000, down 7.7% in just a year, and nearly $80,000 below the frenzied highs of 2022. Over an 18-month stretch, home values have shed 11%, the steepest decline among major U.S. metros. For homeowners who bought or refinanced during the boom, the loss is more than a number on paper. Nearly 8% of local mortgage holders now owe more than their homes are worth, the highest negative equity rate in the nation. National analysts have turned a harsh spotlight on Cape Coral. Reventure app, a data-driven housing tracker, assigns the city a home price forecast score of just 25 out of 100. In their model, anything below 45 signals a market in retreat. A score this low is reserved for places facing deep distress. Local realtors debate whether this is a correction or something more severe, but the numbers leave little room for optimism. Over half of all active listings have endured at least one price cut, many chasing buyers through multiple reductions. The city's rapid reversal has become a case study for housing risk. Analysts warn that excess supply, weak demand, and eroding confidence have combined to push Cape Coral into a downward spiral. As price indices flash red and predictive tools point to further losses, the cost of waiting grows clearer for those still holding out hope for a rebound. Banks in Cape Coral are now facing a different kind of pressure. Over the past year, foreclosure filings in Lee County have climbed to 76 cases. A modest number by historical standards, but a clear sign of growing distress. Loan officers describe a shift in their daily routines. Instead of approving new mortgages, they spend hours re-underwriting existing loans, flagging borrowers whose equity has vanished. Many of these homeowners bought in the final stretch of the boom, often with FHA or VA loans and minimal down payments. Now, as prices have dropped and insurance costs have soared, their monthly payments far exceed what their homes are worth. Servicers report a surge in requests for loan modifications and forbearance, but the options are running thin. Some borrowers are offered repayment plans or short-term extensions, yet rising insurance premiums tip the scales. making even temporary relief unsustainable. For those who fall behind, the clock starts ticking. Legal filings show a growing backlog of delinquent accounts, with foreclosure timelines stretching up to 15 months from the first missed payment to a court-ordered sale. Short sales have become the preferred exit for many lenders, especially in neighborhoods where negative equity is concentrated. In the northern and eastern tracts of Cape Coral, areas built out during the pandemic surge, blocks of homes now sit in limbo, their owners caught between mounting debt and a market that no longer offers a way out. Housing counselors and legal aid teams confirm that most at-risk borrowers are recent arrivals, often with little savings and few alternatives. The numbers may not rival the last crash, but the underlying stress is unmistakable, setting the stage for the personal hardship that follows. Maria bought her home in northeast Cape Coral at the height of the boom, closing in the spring of 2022 for $435,000. Her mortgage rate, 2.99%, felt like a shield against rising costs. But after Hurricane Ian, her insurance premium nearly tripled. The annual bill jumped from $2,200 to over $6,500, more than her car payment and utilities combined. Carrier after carrier left the market, and the last renewal came with a 5% hurricane deductible. Maria's phone filled with messages from her agent. No private insurer would quote her zip code, only Citizens would write the policy, and only at a steep price. By late 2024, Maria's savings had thinned. She listed the house at $415,000, then cut to $389,000, and finally to $369,000. Weeks passed without a single offer. Open houses went empty. Her agent's texts turned apologetic. No bites this weekend. The market's flooded. At night, Maria recorded video diaries for her sister up north. The entries grew shorter, her voice more strained. "I can't even afford insurance. No one's buying anyway. What now?" In March 2025, a foreclosure notice arrived. 90 days behind on the mortgage, Maria faced choices that all felt like defeat. Her HOA's monthly meeting, once filled with talk of landscaping and pool upgrades, now focused on emergency budgets and neighbors looking for a way out. Maria's story echoed across Cape Coral, owners trapped by negative equity, rising bills, and a market that had simply moved on without them. In March 2024, Florida's Governor, Ron DeSantis, convened a closed-door summit in Tallahassee. Around the table sat top real estate brokers, insurance executives, state mortgage advisors, and legislative aides. Leaked memos from the session captured the underlying mood. One slide read, "Cape Coral at highest risk, 11% price drop, 8% negative equity." Advisors warned that if listings rose another 25%, the city's price spiral would be locked in, with broader financial consequences possible for the state. Behind the scenes, the governor's team debated blunt options: insurance rate caps, targeted tax relief, and even state-backed mortgage assistance. The fiscal exposure ranged from $400 million to over $1 billion, according to internal estimates. DeSantis, usually quick to project confidence, acknowledged the scale of the crisis. "Short-term fixes buy time, but we need carriers to stay in Florida, or this unravels." 3 months later, the administration rolled out a public solution. In June 2024, DeSantis announced a $1,000 annual homestead rebate for primary residents, codified as HB 2213. The program excluded investors and second home owners and set an income cap at $145,000 per household. The cost to the state, $420 million per year, with a sunset clause ending the program in 2028. In press conferences, the governor called it critical relief for Florida families. Realtors and analysts offered more measured reactions. Many described the rebate as a stopgap. Helpful for some, but unable to counteract the deep losses in home equity or the relentless rise in insurance costs. Industry groups warned that, without structural reform, the aid risked being little more than a political bandage. For residents, the rebate offered a modest cushion, but the larger questions about Cape Coral's future and the state's ability to contain the crisis remained unanswered. Insurance executives in Florida did not mince words as Cape Coral's crisis deepened. At industry roundtables and in public filings, carrier leaders described a market on the brink. One CEO, whose company withdrew from Lee County in early 2024, put it bluntly, "Premiums at these levels are not sustainable for families or for us. If we stay, we risk insolvency." Behind the scenes, actuarial teams tracked loss ratios that had doubled since Hurricane Ian, driven by a spike in catastrophic claims and mounting reinsurance bills. For older homes in Cape Coral, average annual premiums soared past $5,800, more than double pre-storm rates. Deductibles, once capped at 2%, now routinely hit 5% of a home's value. Executives warned regulators that without swift approval for further rate hikes, more carriers would be forced to exit. Dozens filed requests for 25 to 40% increases, citing both climate risk and a legal environment that amplified every claim. Some carriers began stripping windstorm coverage from standard policies, offering only bare-bones protection or shifting clients to Citizens, the state's insurer of last resort. By late 2024, Citizens held over 30% of Lee County's home policies, a figure that unsettled even the most seasoned actuaries. In closed-door meetings, insurance leaders cautioned that state rebates and temporary relief could not compensate for the underlying volatility. "We can't write policies at a loss forever," one executive told the governor's team. The exodus of private insurers left many homeowners with no affordable options, fueling the outward migration already visible in Cape Coral's swelling inventory and emptying neighborhoods. The insurance system, once a pillar of Florida's growth, now threatened to accelerate the unraveling. Moving vans became a symbol of Cape Coral's reversal. By 2025, the city's once crowded streets echoed with the rumble of rental trucks heading north. Agents in Asheville and Knoxville, cities hundreds of miles away, reported a steady uptick in calls from Florida area codes, former Cape Coral residents looking for a fresh start. National moving data reinforced the trend. The U-Haul Growth Index ranked North Carolina as the second most popular inbound state for those leaving Florida, with Tennessee not far behind. Local coffee shops, once filled with talk of renovations and new neighbors, now buzzed with questions about the best routes out of state and which towns offered affordable insurance. The scale of the exodus is written in hard numbers and daily routines. In 2021, Cape Coral welcomed a flood of newcomers. By 2025, the flow has reversed. While official migration counts lag behind, the evidence is everywhere. Utility disconnects, school enrollment drops, and a glut of homes left vacant after unsuccessful sales. Real estate agents describe empty open houses and weeks without a single showing. One longtime resident, loading boxes into a rented trailer, summed up the mood. "We came for the dream, but we can't afford to stay. Everyone on this block is talking about leaving." Families with young children point to ballooning insurance bills and property taxes as the final straw. Retirees on fixed incomes, once drawn by Florida's no-income tax promise, now seek out states where homeownership doesn't come with annual surprises. Some head for the Carolinas, lured by lower premiums and a sense of stability. Others look west to communities where housing costs remain within reach. Realtors in destination cities describe a new kind of client, Floridians eager to trade palm trees for mountain views, motivated more by cost than climate. The outward push isn't limited to those in crisis. Even homeowners with equity are choosing to sell before values fall further, hoping to lock in gains from the boom. The result is a visible, if hard to quantify, migration wave. Moving trucks line the streets, and the city's reputation as a haven for newcomers has faded. Cape Coral, once a symbol of Florida's growth, now stands as a cautionary tale, its outbound migration reshaping the narrative far beyond the state line. National media outlets seized on Cape Coral's reversal, casting the city as a warning for every boomtown that soared during the pandemic. Headlines in the Wall Street Journal and housing analytics platforms like Reventure app labeled Cape Coral the worst buyer's market in America. Data-driven reports pointed to the city's home price forecast score, just 25 out of 100, the lowest among major metros. In interviews, analysts described a market where excess supply, eroding confidence, and runaway insurance costs collided to erase years of gains. Press coverage zeroed in on the sharp contrast between the city's rapid rise and its equally swift decline. Charts of inventory spikes and price drops became staples of national broadcasts. One segment on CNBC paired drone footage of half-empty subdivisions with a crawl of statistics: 11% price drop from the peak, 8% of homeowners underwater, and more than half of all listings discounted at least once. Commentators drew parallels to Sunbelt busts of the past, but noted that this time, the triggers were not just speculative buying, but climate risk and insurance instability, forces with implications far beyond Florida. Policy experts weighed in from think tanks and university housing centers, warning that Cape Coral's story could repeat in other fast-growing markets exposed to natural disasters or runaway costs. Reports from the Urban Institute and Harvard's Joint Center for Housing Studies cited Cape Coral as a case study in the dangers of unchecked building and the fragility of insurance-backed homeownership. Editorials questioned whether state-level responses, like the $1,000 homestead rebate, could do more than buy time for struggling families. The rebate, praised as immediate aid, drew criticism for excluding investors and offering no fix for the underlying drivers of distress. Local politicians and business leaders pushed back against the crash narrative, insisting the market would stabilize. But national observers saw deeper risks. Analysts pointed to unresolved issues: insurance premiums still outpacing wages, property taxes climbing, and no comprehensive reform in sight. The debate spilled into policy circles as lawmakers in other states asked whether their own boomtowns might face similar fates if migration patterns reversed or climate threats intensified. Cape Coral's experience became a staple in housing conferences and risk management seminars. Slideshows paired before and after maps with cautionary bullet points: overbuilding, investor withdrawal, climate shocks, and the limitations of short-term relief. The city's journey from pandemic darling to cautionary tale now shapes how experts and policymakers talk about the future of housing in America's growth corridors. As the headlines fade, the lessons linger, reminding markets everywhere that rapid gains can vanish just as quickly, especially when the foundations are built on shifting ground. By May 2025, Cape Coral's median home price had fallen to $361,000, down 11% in just 2 years. Over 50% of sellers had cut their prices, and nearly 8% of homeowners were underwater on their mortgages, the highest such rate in the nation. Official documents show that Governor Dantis's $1,000 homestead rebate offered some relief, but policy records and industry testimony confirm that deeper issues like soaring insurance premiums and stalled reforms remain unresolved. The number of foreclosure cases, while still modest, continues to rise. Migration data from the U-Haul Growth Index reveals that more families are leaving Cape Coral for states like North Carolina and Tennessee, seeking lower costs and fewer risks. Yet the full impact on Cape Coral's community fabric and long-term recovery remains unknown. As the evidence stands, Cape Coral's boom-to-bust story is now a cautionary lesson for every American boomtown chasing rapid growth without safeguards.